Hello everyone, and welcome back to Explain the Charts. Today is October 6th, 2025, and we are taking a deep dive into the S&P 500 ETF, SPY, which is sitting at a fascinating crossroads. The market is currently being pulled in two different directions, making it a critical time for traders and investors to pay close attention. On one hand, we have some significant macroeconomic headwinds creating uncertainty. News reports from last week highlighted the first U.S. government shutdown in nearly 7 years, which naturally puts a damper on economic sentiment. This was compounded by a surprise ADP report showing 32,000 job losses, which fuels concerns about a potential slowdown. Interestingly, this bad economic news has also increased bets that the Federal Reserve might be forced to cut rates sooner rather than later. On the other hand, the market narrative is also being driven by powerful bullish forces, particularly in the technology and AI sectors. We've seen headlines about an AMD OpenAI deal boosting market hopes, and analysts noting the continued resilience of the U.S. economy. This optimism has pushed major indices to record highs, with some analysts advising investors to stay long despite bubble concerns. So we have a classic tug-of-war. Macroeconomic fear versus sector-specific euphoria. Now, let's see how this conflicting narrative is playing out on the charts. Looking at the daily chart for SPY, the first thing that stands out is the clear, long-term uptrend we've been in for most of the year. The price has been consistently setting higher highs and higher lows, which is the definition of a bullish market structure. However, this uptrend has not been without extreme volatility. Let's zoom in on a particularly wild period back in early April of this year. Here we can see a massive drop where the price fell from around 567 down to a low of 481 in just a few trading days. That's a nearly 15% correction that happened incredibly fast. But just as quickly, it was followed by a V-shaped recovery that erased almost the entire loss within days. This period serves as a stark reminder of how quickly sentiment can shift and the kind of volatility this market is capable of. It also establishes a major long-term support zone way down between 480 and 500. Now, let's return to the full view of the chart and look at more recent price action. Back on the full daily chart, we can see the price action that corresponds directly with the news we just discussed. On October 1st, we saw a gap down at the open, with the market reacting negatively to the government shutdown and jobs report news. The price fell from a close near 666 down to an open of 663, ultimately closing near 668 after a volatile session. But what followed is incredibly telling. The market immediately shook off those fears, rallying strongly on October 2nd and 3rd to close the week at a new all-time high. The high on Friday, October 3rd, reached 672.67, which now stands as the key resistance level to beat. This price action suggests that, for now, bulls are firmly in control and are choosing to focus on the potential for Fed rate cuts and the strength in tech over the government's political issues. The immediate support level to watch is the low of that October 1st candle, around the 663 mark. A break below that could signal that the bearish sentiment is starting to take hold. For a more granular view, let's switch to the hourly chart. Here on the 1-hour chart, looking at the past couple of weeks, we can see the climb to the recent highs in more detail. We see a strong uptrend from the 654 level around September 25th. The price consolidated a bit before the sharp, news-driven dip on October 1st, which took us from above 669 down to that 663 support area. The subsequent rally was powerful and consistent, with very shallow pullbacks. This indicates strong buying pressure. The price is currently consolidating just below the all-time high set on Friday. This is a common pattern. After a strong move up, the market often pauses to gather steam before its next leg. Key short-term support on this time frame appears to be around the 668 level, which was tested during Friday's session. A break below this could see a retest of the 663 to 664 zone. On the upside, a sustained break above 672.67 would open the door to price discovery and a new rally. Let's switch to the 15-minute chart for an even closer look at Friday's action. On the 15-minute chart, we can observe the intraday battle between buyers and sellers on October 3rd. The market opened strong, pushing up to establish that all-time high of 672.67 around midday. After hitting that peak, sellers stepped in, pushing the price back down. However, buyers defended the 668 level multiple times throughout the afternoon. The day ended with a bit of a rally off those lows, closing near 669. This shows that while there is profit-taking at these new highs, there is also significant demand underneath, with buyers stepping in on any dip. This intraday range between 668 and 672.67 will be critical to watch at the start of this week. A break of either side of this range will likely dictate the market's direction for the next few sessions. So, to recap, let's bring it all together with the key levels and potential scenarios. The immediate and most important resistance level is the all-time high at 672.67. On the support side, we have short-term support at 668, followed by a more significant zone around 663. Below that, the next major support area from the daily chart is around 635. So, what are the likely scenarios? The bullish scenario, which I would give a 65% probability given the current trend strength, is that the market continues to shrug off negative news. We would look for a breakout above 672.67, confirmed by high volume, to signal a continuation of the rally. This likelihood is reinforced by the persistent optimism in the tech sector and growing expectations of Fed easing. The bearish scenario, which I'd place at a 35% probability, involves the macroeconomic fears finally taking over. This would likely start with a failure to break the all-time high, followed by a break below the 668 support level. A confirmed break below 663 would strengthen the bearish case, opening up a potential correction towards the 635 level. Worsening news about the shutdown or more weak economic data would increase the likelihood of this scenario. Key things to watch for this week will be any new inflation data, further employment reports, and of course, any headlines coming out of Washington regarding the government funding situation. Your trading decisions should be heavily influenced by which side of the current 668 to 672 range the market chooses to break. And that concludes our analysis of SPY for today. Please remember, this video is for informational and educational purposes only and should not be considered financial advice. Always conduct your own research and due diligence before making any investment decisions. If you found this breakdown helpful, please hit the like button, subscribe to Explain the Charts, and ring the bell so you don't miss our next update. Thanks for watching.